Now that we have determined our trade setup, the next thing to do is to scan for stocks that fulfill these criteria. So the first scan we're going to do is for both the upper and lower Bollinger Bands to be inside the Keltner channel, i.e. we're looking for stocks which are in a period of low volatility. The meta-stock formula for doing this exploration, as it's called, is the Bollinger Band top lower than the Keltner top, and the Bollinger Band bottom band greater than the bottom band of the Keltner channel. I've scanned the FTSE 100 index on this occasion, and we've got 5 candidates who have popped out here. Funnily enough, or not funnily enough, but Scottish and Southern Energy, one of the stocks that we've been looking at, is one of the candidates. Now here are the 5 plots, and what you can see here, in each case we've got our Bollinger-Keltner binary indicator firing off, and if you just eyeball these stocks you can see that after a period of reasonably high volatility that we're now currently in a period of low volatility. Now, whereas this has gone part of the way towards identifying possible trades, it hasn't gone all the way, because just because a stock has gone into a period of low volatility, it doesn't mean it's going to break out tomorrow or the day after. As you can see here with the Hammerson, it's been in a squeeze here for quite some time. In order to find specific trade setups, we now need to refine our criteria. In this case, we're going to be looking for stocks where the upper and lower Bollinger Bands were inside the Keltner channel yesterday, were also inside the Keltner channel the day before. However, on the current bar, either the upper or the lower Bollinger Band, or perhaps both, are now outside the Keltner channel. For your interest, this is the metastock indicator that performs that search. I did search the FTSE 100 for stocks having that particular setup, and I didn't find any, because actually the criteria are now very narrow. So I've extended my search to the FTSE 350, and I've come up with 2 possible candidates, the Mitty Group and Colin Stewart. Looking at the charts, this is what we see. We can see that Colin Stewart has been in a trading range now for quite some time and is just showing signs of breaking out. The Mitty Group has been slightly more erratic, but we may have a potential setup here also. And you can see the momentum indicators at the bottom here giving us a slight heads up on the long side for Colin Stewart and a potential breakout to the short side for the Mitty Group. This presentation is based upon one that I delivered to the Traders Investors Club a few weeks ago. So we're now able to have a look at the Mitty Group and Colin Stewart and actually see how these trade setups performed. Here are the charts. As you can see, the breakout on the Collins and Stewart chart is really quite decent, and we've had quite a nice little run here so far. The Mitty Group not quite so good at the moment, but you know, there could be quite a nice little trend building here. We'll just have to keep an eye on it. The final concept that I want to discuss is the use of the average true range indicator that will help us to place our stop loss orders in an objective fashion. The average true range indicator was developed by Wells Wilder, and the beauty of this indicator is that it caters for gaps that occur between the closes of the day before and the openings of the next day. Now the true range is the greatest of the following 3 values: today's low to today's high, or yesterday's close to today's high, or yesterday's close to today's low. So once we've determined which is the greatest of these 3 values, that actually gives us the true range for the particular day that we're examining. What we can do then is to tack all these true ranges together over a particular period of time. We often use the 10-day average true range indicator, which represents 2 trading weeks. And we get an indicator here which is a basic and a pretty decent measure of volatility. And as you can see, I've plotted it just underneath the monthly volatility plot that we've been using previously, and you can see that it follows it pretty closely. Now, what does this tell us when we want to place a stop in the market? Well, we're back to our old friend Xstrata here. And first of all, we look at what the average true range reading is, and it's about 42. Now, what this is telling us is that over the past 10 days, the daily range of Xstrata has averaged about 42 points. So if we now want to place a stop against a long trade in Xstrata, we need to at least place it 40 points away. Because obviously if we place it close enough, which puts it within the expected daily range, it's going to be hit tomorrow. So a rule of thumb that I like to use is just to place the stop twice the average true range away from the entry price. So that means if I enter a long trade in Xstrata here, we're about 1170, with the average true range being just over 40, our stop goes down here approximately 80 points below. And this should keep us in the trade and allow for any short-term volatility moves in Xstrata. This ends our little discussion of volatility. We've discussed a lot of concepts in a very short period of time, so I do apologize if I haven't gone very deeply into any of them. If you would like to ask me anything about these strategies or any of the points discussed, you're very welcome to email me at kevin@tradersinvestorsclub.co.uk, or please leave a comment underneath. Thank you very much, and I look forward to catching you next time around.